Welcome everyone to my newest micro course. If you want a copy of this presentation, don't forget to join our community. Today, we're diving into 8 essential contract contingencies or purchase conditions that can save you from costly mistakes and give you peace of mind during your home purchase. Buying a home in California is a huge step, and we want to ensure you're protected. Think of contingencies as your safety net in the California real estate market. What exactly are contingencies? Contingencies are essentially conditions of purchase or escape clauses in your purchase contract. They provide a safety net, offer time-limited protection, and most importantly, protect your earnest money deposit. Let's explore how these work in practice. Let's start with the loan contingency. The loan contingency means that within a certain amount of time, you must be approved for the loan to purchase the house. This is a crucial piece of financing protection. From the moment of acceptance, you have up to 17 days to secure financing. This contingency provides an exit strategy, allowing you to cancel the contract and get your deposit back if your loan is denied. Remember, you'll need to provide written evidence of the loan denial to properly exercise this contingency. Here's a real-world example. Carlos and Maria offered $600,000 on their dream home. Thankfully, their loan contingency was in place. When the lender discovered some recent credit issues that decreased Carlos's credit score, they couldn't qualify for the loan. Because of the loan contingency, they were able to cancel the contract and get their $18,000 earnest money back, avoiding a potential financial disaster. Next up is the appraisal contingency, which helps you avoid overpaying for a property. This contingency verifies the home's value, protects your lender's investment, and gives you negotiation power if the appraisal comes in lower than the agreed-upon price. It's a vital safeguard in California's competitive market. Next is the inspection contingency. It allows you to hire home inspectors or a general home inspector to do a thorough inspection for a complete investigation of the property to uncover any hidden issues. You can then request repairs from the seller or negotiate credits for necessary fixes. This contingency, typically lasting up to 17 days in California, gives you peace of mind knowing you fully understand your property purchase. It is important to notate that you have the right to request repairs or dollar credit for repairs, but the seller has the right to refuse making the repairs or provide credit. If the seller refuses to repair or give credit, you have the option to continue with the transaction or cancel and get your earnest money deposit back. What kind of inspections should you consider? A general home inspection is a must, followed by a pest inspection, especially important in California. Depending on the property, you might also need specialized inspections for things like the roof, foundation, or HVAC system. Don't forget to check for mold and moisture issues as well. Next up is seller-required disclosures. California has strict seller disclosure requirements, and the seller disclosures contingency is your chance to review them thoroughly. The transfer disclosure statement, or TDS, is key. It reveals the property's condition, any known defects, past repairs, and even neighborhood issues. Take the time to carefully review these documents during the contingency period, which is typically up to 17 days. Let's dive deeper into critical California seller disclosures. The Transfer Disclosure Statement, or TDS, is a comprehensive report on the property's condition. The Natural Hazard Disclosure, or NHD, reveals potential environmental risks like wildfire zones or earthquake fault lines. And finally, supplemental disclosures cover things like water damage, neighborhood noise, or even deaths on the property within the last 3 years. The Preliminary Title Report contingency is all about understanding the property's ownership history. This report reveals potential issues like undisclosed liens, easements, which is access rights, or encroachments that could affect your rights as the new owner. Review this report carefully to ensure a clean title. If you're buying a condo, planned community, or a property governed by a Homeowners Association, the HOA CC&Rs contingency is essential. You'll want to review all governing documents, assess the HOA's financial health, and evaluate the rules and restrictions to ensure they align with your lifestyle. What are some HOA red flags to watch out for? Low reserve funds can indicate potential future special assessments. Pending litigation could lead to unexpected costs. A high delinquency rate among homeowners can signal financial instability. And frequent fee increases might strain your budget. Given California's increasing wildfire risk, the fire insurance contingency is more important than ever. Securing adequate fire insurance coverage is crucial, but in high-risk areas, premiums can be very high, or coverage may even be unavailable. This contingency allows you to assess the insurability of the property before committing. So, how can you navigate the fire insurance landscape successfully? Start getting insurance quotes as soon as your offer is accepted. Shop around with several insurers, including the California Fair Plan, which is a state-run option. And consider home hardening measures to reduce your premiums. The leased items contingency covers items leased or financed separately from the property, like solar panels, water softeners, or security systems. Decide whether you want to assume these contracts or request that the sellers pay them off before closing. These contracts can significantly impact your ongoing costs. But remember, the seller has the right to refuse to pay them off. This is part of negotiation. But if the seller refuses, you can exercise your right to continue or cancel the purchase. Here's an example. Alicia purchased a home with leased solar panels. The lease terms were unfavorable, so she negotiated for the seller to buy out the lease before closing. This saved her from being stuck with a costly and restrictive contract. Let's look at a typical contingency removal timeline. Within the first 3 days, you'll make your initial deposit and order the preliminary title report. Within 4 to 10 days, schedule and complete your home inspections and apply for your loan and insurance, and review the seller-required disclosures. Around day 17 is the standard deadline for removing all contingencies, including inspections, disclosures, title, loan, appraisal, insurance, leases, and HOA CC&Rs. Remember, these deadlines can be reduced or extended during negotiations, so check the purchase agreements and counteroffers for details. What happens when issues are found during the home inspection? You have several options. You can request repairs from the seller, negotiate a credit at closing to handle the repairs yourself, or compromise by focusing on major issues. And of course, you always have the option to walk away if the issues are too severe or the seller won't negotiate. Strategic contingency management is key. Track your deadlines carefully by calendaring contingency removal dates and setting reminders. Don't hesitate to request extensions in writing before deadlines expire. And most importantly, work closely with your real estate agent to evaluate findings and negotiate solutions. And lastly, do not remove a contingency unless you have cleared everything with your realtor or loan officer for a smooth closing. My best advice is to consult with your loan officer and real estate agent before removing any or all contingencies to avoid a mistake that can cost you money. Contingencies are your financial safety net when buying a home in California. They provide critical protection during what is likely the largest purchase of your life. Share this information with your friends who are house hunting in California. Happy house hunting!